What is going on, guys? This is Thick Teddy, and this is another episode of Buy and Hold. And today we're talking about BABA, BABA. Before I get into starting off the technical stuff, I want to say thank you guys for tuning into this video. I obviously enjoy making these a ton, so drop a like, drop a comment of a video that you want to see me do, subscribe to the channel, show it some love, that sort of stuff. Thank you guys. But let's get into technically what Baba is looking like at the current moment and where are some levels that I could see being possible buy areas for Baba long term. So this chart here is looking very similar to a lot of other tech charts we've seen with a little bit more of a twist. The twist on this is it's a Chinese company, so we've seen quite a bit more downside recently than something like an Amazon or something like an Apple, because at all-time high, this thing was $320, and a few months ago, we saw $60, 58 if we want to be exact. We saw $58 after a $320 all-time high. We don't have many tech stocks in America with as large of a market cap as Baba that have seen that sort of a move. But this thing has rallied the past couple months. This thing is up to $114, $115 from $58. That's nothing to bat an eye at. So we need to determine where are the levels that we personally feel comfortable. And this video is obviously going to highlight what I feel comfortable with. So you guys need to determine what you personally feel comfortable with. But these are going to be my levels. So we're at $115. I'm not willing to buy it on this large of a move to the upside, but I am willing to buy this above this low area. I think this low area is going to be a spot moving forward that could be a possible last scale in or second to last scale in. So starting off, I'm going to feel pretty comfortable buying this at $80 even. I think $80, $81 I think is going to be a great area to start scaling in. We saw it bounce a few times there back in March, May, and then June. So I'm feeling like $80 is a pretty decent area to begin adding this long term. If we want to add another one in there, I think 73 is another spot that you could definitely add this long. I'll make this a little bit bigger so that we can see a bit better. The third one, I think is $63. We're adding at 80, 73, 63. It's a pretty good $10 increment or somewhere around there. I think that's another great area to add at based on it being the bottom of these candles that we saw in October. We're gonna have to go a little bit further back for this other one, but I think let's get it in there. Right below the low that we made in October is another great area. So 57, 58, somewhere in there. That coincides with all-time low on Baba. If you go to the yearly, let's go to the yearly. This is the yearly. You can see the wicks on that 57, 58 area. It's a great spot to be long. It's a perfect spot for that last ad because we've seen it work out so many times. Let's go back to this weekly. So these are my four levels, 81 to 80, 73 to 72, $63, and then 57 to 58. I think those are perfect levels for you to scale into Baba, considering it's at 115 right now. So if this comes down to 80, you're getting a discount even on this little run that we're seeing at the moment. After it has come down from $320, you're already getting a great discount. If you were to buy it right now, you'd be getting for a third the price that we saw at all-time high. So you can't go wrong with that. But for me personally, I'm not feeling comfortable buying it at $115. There's some resistance coming up if you want a bit of technical analysis from this weekly. There's resistance from about 113 all the way to 126. So if we don't clear that, then we could be heading right back down for this 80 level. And we were only, 2 weeks ago, we were at $85. So it's not impossible we see 80 in a couple weeks. That's how I'm feeling about these levels. I'm going to stop it here for a second. I'm going to pause for a minute if you guys want to screenshot these, do it now. And I'm going to begin to talk about Baba fundamentally. So Chinese stocks have always had a little bit of a cloud around them, like I mentioned earlier, about their fundamentals, their financials, all of that sort of stuff. It stems from, back in the day, early 2000s, late 1990s when there was a lot of stuff happening, 20, when was it? I don't know, early 2000s to the 2010s, there was some pulling the wool over the eyes of U.S. investors. Let's get to their fundamentals now. There was pulling the wool over the eyes of the U.S. investors, and we've seen that multiple times, and we've also seen some stuff where Chinese banks have collapsed recently, and it's not looking good for Chinese, companies as U.S. investors looking outwards towards those Chinese companies. It's similar to when I talked about coin months back after FTX had failed. That sector was feeling some stress based on that FTX failure, and this is the same. Chinese are feeling some stress after that bank collapse and that massive I don't even know what to call it, downfall that we saw about a year ago. There was some crazy stuff that happened there. Lots of people lost money. There was a lot of people in a lot of debt because of it. There was just a lot of bad stuff. And being a US investor, looking at that, it's not, the calling card. It's not telling you, let's run over there and get into these companies. It's telling you, stay far away, keep it at an arm's distance. Keep it out here, keep it far away. Don't touch it with a 10-foot pole. That's the sort of thing that those headlines give you about Chinese companies when that sort of stuff happens over in China. There's also going to be some stuff that we talk about later in this episode about, the Chinese government purposely messing up some of these tech companies' opportunities. For what reason? Because their leaders didn't agree with everything that the government was doing. So that's also a risk of Chinese companies. But let's talk about these fundamentals. So the market cap, 285 billion, large ass company, massive company. Income, $2 billion. We don't love to see that. We do not love to see that. The margins are not great there. We've seen some downside of those margins recently, and we'll talk about those when we talk about their earnings reports. But I think that we're going to see a bit of an uptick on those margins, but it's not a done deal. I don't want to say, I don't ever like to say we're going to see an uptick in those margins. I'm feeling it based on looking at all the numbers and looking at a lot of the stuff they're doing business wise. I think we're going to see those margins grow to a better place in the next few years. Sales, $124 billion. So book to share is 52, cash per share is 27.46. The PS ratio is 2.2. We love to see that. That's a great PS ratio. PE ratio right now is 155. We do not like that. Forward PE is 12, indicating that they're going to get a lot better with those margins moving forward. That's what analysts see. That's what I see as well. I don't see them doing as well as what the forward PE indicates, but I do think that they will get better with those margins. The PS ratio makes up a bit for the current PE ratio. We see the PE is really, really bad. The PS makes it, a little bit more manageable. The PB, definitely not bad at all. PC, definitely not bad at all. So I'm not mad at any of these numbers. I actually really like the PS, PB, and PC. Quick ratio, debt to equity ratio, current ratio, LT debt to equity ratio are all within the ballpark of something I'm willing to accept. None of them are great. None of them are bad. If we look at the earnings reports, their EPS this year is down 60%. That's kind of another example, another kind of thing we can put on the pedestal to talk about why that margins is so slim, is because their EPS, the margins are causing the EPS, but you guys understand that already. The EPS is so bad right now because those margins have decreased and because their margins are struggling. And I think some of the stuff that we're seeing with the Chinese regulation is really, really going to help that moving forward. We saw a big move last week on Baba based on one of the subsidies getting completely ceded by Jack Ma. We're going to talk about that a little bit later and how that impacted the Chinese government's outlook on Baba and those other large tech companies. But I think that's the main mover of these margins. I think they're going to get a little bit of help from the Chinese government in this. They're going to get a little bit more of a free path to better margins. They're going to get less regulation in front of them. They're going to get less obstacles is essentially what that means. So EPS struggled this year due to those margins. I think it's going to climb back up a little bit next year, and I think the earnings reports are going to kind of show that. But if we look at institutional ownership and institutional transactions, this is a bit concerning. Institutional ownership 14.7, institutional transactions minus 10%. That is like what is this? Almost 50% decrease? Not quite. It's a little bit off, but my brain doesn't want to math right now, but it's less than 50%, but that's a pretty big move in itself. So we went from 25% to 14%. That's got to be somewhere in the ballpark of like a 33% move to the downside, something like that. But institutions are selling. It's a bit concerning. We're seeing the target price from analysts at 133, so we're getting up there near the target price for analysts after all those downgrades in the past few years based on those margins and based on the Chinese crackdowns. We're seeing 93% off a 52-week low on that as well. We talked about that earlier. So these are all of the fundamentals that you guys can check out. I gave you guys my opinions. I like the PS, PB, and PC. Those are the three biggest things. I don't like to see the institutional transactions at a negative 10% when there's only 14% left. I don't like the margins all that much, but I do think there is reason to believe that those margins are going to get better in the future. Let's look at their revenue distribution here. So this is another fundamental part of the company. How are they making money? And first off, you guys can see that Chinese commerce retail is at 66%, the highest by a landslide. That's basically their Amazon-looking, platform. But there's a big difference between what Amazon does and what Alibaba does. Alibaba or Baba, their main thing is they supply seller to seller. So they're supplying these wholesale. Think of Costco. They're supplying these massive wholesale things, but Costco on even a bigger scale. So they'd be selling. Okay, I have these nuts. They'd be selling. Just an example. They'd be selling, 1 million of these packages of nuts to another seller who would sell them to customers themselves. So Baba is not really focusing on the seller to consumer connection as much as Amazon. Amazon is really seller to consumer. They're looking to, if someone wants to sell these nuts, Amazon's going to say, put them on my website and we will help you sell them. We'll give you a platform to sell your nuts. Baba is saying, give us 1 million of those. We're going to sell them to this Diet Coke right here. And this Diet Coke is going to sell all of these nuts themselves. So the Diet Coke would have all the nuts. Baba doesn't have to deal with any of the selling or any of the connection to the consumer. They just gave them to the Diet Coke, and now the Diet Coke is selling all of the nuts. I don't know if that made any sense or if I just sounded like a Facebook grandpa, but you guys get what I mean. It's more seller to seller connections of wholesale products and larger quantities of products. And then obviously they have other business ventures. They have cloud computing. They have logistics services, local consumer services, international commerce retail. So, the international commerce resale is really small because they're a China-based company, similar to Amazon, where Amazon is trying to expand. Baba's not trying to expand as much. They have digital media and entertainment, international commerce wholesale, China commerce wholesale, innovation initiatives, and others. So, moving forward, we can see that this is the e-commerce company. This is a Amazon-esque company. It's just not an American company. So a lot of the investors are struggling in the United States, feeling comfortable about their Baba investment. Let's move on to this here. This is their earnings report, and this is the reason why a lot of those investors are not feeling comfortable. You guys can see those projections. In 2021, quarter four, their projections were estimated to be $1.88 per share, and then their projections dropped all the way to 67 cents per share. And then they were 83 cents per share, and then they were $1.37 per share. And then they're projected now $1.77 per share. So those projections have dropped pretty heavily in 2022, and that was kind of the main reason for a lot of the investor loss of positive sentiment, the flip to the negative side of the sentiment. Because when companies give you guys an outline of what they're expecting out of themselves, that's pretty heavy. That's something that you're going to believe and you're going to want to use going forward as an investor is, this company is saying that they think they're going to raise guidance or they think they're going to lower guidance. If they lower guidance, you might run away for a little while. You might think this is a company that I need to take a year off of from investing and then I'll look back towards it. But Baba did that, but they're climbing back. You can see here that their quarter four is looking closer to their quarter four of last year. And then already back in quarter two next year, they're coming back up into the 170s. And then quarter three, they're at 178, which is higher than their quarter four expectations. So they're on the path to potentially making new highs on their EPS, making new highs on their revenue, making new highs on those margins, possibly. They're going to have to execute it, but possibly. They're thinking as a company, these regulations from China are getting raised. We're going to have an easier path to do it. So the guidance is going to be good. So they have good guidance moving forward, which I think is a pretty bullish thing to have. But there are some issues with Chinese companies we need to talk about. So this is from Barron's, and it says Chinese companies eventually have had their time in the past where there's been a lot of negative things. They're having their time now where those bank collapses have caused negative things. But here's the main core of that. U.S. regulators don't love the arrangement. Let me highlight this so that you guys can read along with me. U.S. regulators don't love the arrangement because Chinese companies have spotty financial reporting. That's by design. China views many accounting details as state secrets. U.S. lawmakers have told these companies to comply or delist, and China says it will provide more financial information, but there's also a 3-year period that companies can use to set up secondary listings, and some have done that in Hong Kong. These H shares, as they're called, also offer VIE exposure rather than true ownership. So the financial side of being a Chinese company is different than being a U.S. company. Chinese companies don't have to, comply to the same rules that U.S. companies do. Baba does a good job of financial reporting, but there's also the chance that we're getting the wool pulled over our eyes completely. There's a chance that Baba has somehow foregone the system, and there is just a massive, fraudulent reporting system happening. I don't think it's happening with Baba. I do not think it's happening with Baba at all. I don't think it's happening with many of the large Chinese tech companies, but there are people out there who believe that, companies like Baba are capable, with the help of the Chinese government, of completely fleecing U.S. investors. I personally don't think it's possible. I'm going to repeat that, but there are people out there who do believe that. So there's your risk side of this. Your other risk side of this is also involved in the Chinese crackdown. So this reads, China's crackdown on tech giants is basically over, top official says. So China's heavy-handed crackdown on tech giants is coming to an end, and the country's economic growth is expected to be back on track soon. The crackdown on fintech operations of more than a dozen internet companies is basically over. So what happened? So Jack Ma gave control of Ant. He completely gave it up. And then the government is all of a sudden like, oh, we're back on track with you. What does that tell you about investing in a Chinese company? They have to comply with their government, or else they just get completely fucked with a capital F. If they do not follow exactly what the government wants from them, then this will happen. You're going to see a stock top at $300, and then you're going to see $60 after the government completely, iron fists them, which is what happened with Baba. Baba saw just some massive obstacles put up between them and their goals of revenue and sales because of the Chinese government. The Chinese government themselves came between Baba and profit. That's the basis of what you need to know here. The Chinese government decided that until they got what they want from Jack Ma, they were going to absolutely cause Baba to decline like this. They caused their earnings, they single-handedly caused their earnings reports, caused their guidance to have to be lower, caused them to have to basically reevaluate their margins. And then when Jack Ma gave what they wanted, they said, okay, you can go back to normal now. So that's the risk you're dealing with the Chinese company. And for me personally, my exposure on a Chinese company, I have it in my rules, has to be 1/4 of a U.S. company. So if I'm investing a position size, say, let's just throw a random number out there. Say I have $1,000 per position. In a U.S. company, I can put that full $1,000 in, which is a position size. For a Chinese company, it would have to be $250. If I'm investing $100,000 per company, say I'm a high roller, it would have to be $25,000 for a Chinese company. So that's how I feel about Baba. I think it's a decent investment, but I don't see why I would pick it over Amazon. I think Amazon is the better investment all around. I think Amazon is the safer investment, and I think Amazon probably has bigger, nicer growth opportunities moving forward. So comparing the two, I would take Amazon, but Baba is definitely not a bad choice considering the discount that you're getting it on. Let's go back to that chart quick. This is quite the discount. I don't think you can throw this out and say, I don't want to invest in this. You just have to be safe with it. So for me, that safety comes from using 1/4 the position size. that's going to be the video, guys. I hope that this really helped you guys out, seeing, the difference between investing in a US and a Chinese company. And I hope you guys got a great insight into Baba today. So thanks for tuning in, and I will be back next week. Peace out, guys.